What's up guys, this is Gerard, back to you with another tutorial video on taxation. On this video, I'm going to be explaining taxes on dealings in properties. Dealings in properties involves disposition of either ordinary or capital assets through sale or exchange. When we say ordinary assets, these are type of assets that are used in the business, such as property, plant, and equipment, inventories, or supplies. Conversely, when we say capital assets, these are assets that are not classified as ordinary assets. Now, the capital assets that we're going to be talking about here are assets that are not real properties or shares of stock. You can watch my capital gains tax video to learn more. Now, in computing gains or loss in dealings in properties, we will be comparing the selling price with the carrying amount or the cost of such asset. To begin, let's make a diagram. We can start with classifying the assets sold, which could either be ordinary or capital asset. For ordinary assets, the full amount of gain from the exchange or sale transaction will be recognized in the net income and subject to income tax. For loss, however, it shall be allowed as a deduction in full. Let's go to the other side. To reiterate, the capital assets that I am pertaining here are those aside from real properties and shares of stock. You can read more about the guidelines in determining whether a particular property is a capital asset in Revenue Regulations 7-2003. Now, the sale of capital assets could be done by either an individual or a corporation. Now, if the sale or exchange was done by an individual, Section 39B of the tax code as amended shall take into effect, wherein we have to determine the holding period. If the holding period is not more than 12 months, the gain or loss shall be recognized in full. On the other hand, if the holding period is more than 12 months, 50% of the resulting gain or loss will be recognized. Now, for corporations, regardless of the holding period, the recognition shall always be in full. In addition, any capital loss shall be recognized up to the extent of the limit of the gains from such sale or exchange. So let's have illustrative problems. The taxpayer had following transactions in relation to capital assets. So to solve for the net capital gain for tax purposes, we scrutinize the assets that were sold. We have motor vehicle, jewelries, artworks, luxury bag, and parcel of land. Now, the parcel of land sold will be subject to capital gains tax, so we'll ignore that real property in our computation. Next is determine the percentage of recognition with regards to the holding period. As you can see, for long-term holding period, 50% will be recognized, and for short-term period, 100%. Multiplying the percentage with the actual gain or loss, we can determine the recognized gain or loss for tax purposes. Therefore, the individual taxpayer's net capital gain from dealings in properties is $215,000. Let's go to our second illustration. A hotel and resort corporation had the following dealings in its properties. So to determine the net capital gain, we need to look into the type of assets sold again. Based from the nature of the corporation, the hotel building is an ordinary asset. So only the gain or loss from the investment in bonds and treasury bills will be used in computing the net capital gain, which is $70,000. Observe that we did not determine any holding period anymore because the taxpayer is a corporation. And that's it. So let me know what you guys think about this topic in the comment section below. Thanks for watching. If you found this video very helpful, please give it a thumbs up. And if you're new to the channel, make sure to subscribe. Lastly, hit that notification bell so you'll be updated with upcoming tax tutorial videos. So this is Gerard. I'll talk to you in the next one.